Hello and welcome to the Weekend Investing Daily Byte of 10th of October. And I'm shooting this a little earlier than the market close due to some reasons, but largely the trends are very clear. Today in our video, we want to first pay homage to Mr. Ratan Tata, who left us yesterday. And I think what I would like to say for a minute is that there are a lot of business folks, there are a lot of industrialists, but the kind of love he generated from everybody for himself and for his work, I think that is exceptional. People don't remember him for the money or the wealth he generated, but for his contribution and for his for the moral compass to be in the right direction all through his reign at Tata Motors at Tata uh, investments. So he was saluted by most Tata stocks today at 2:30 p.m. You can see Tata Investments up 8%, Tata Tele, Tata Chemicals, Tata Coffee, most of it, and some were also up in the morning, succumbing to some market pressure later on. But I think there's a lot of uh, you know uh, uh, inspirational messages that have come through his life, and a lot of folks I don't think view other industrialists or capitalists or business folks in the same light. So he was truly exceptional, and my hats off to him, and essentially my condolences. Today's daily bite, as I mentioned, will cover market happening till 2:30. And is India's gamble in equity going to pay off? This is going to be our topic of discussion in the second half. So far, you can see that the market is not really willing to go up. We are at 0.16% at 2:30 p.m. And this second shoulder that I was mentioning yesterday is remaining to be a possibility. So that is a bit scary. Nifty Junior also very flat, minus 0.16%. Mid caps also gave up morning gains, minus 0.15%. Small caps are at yesterday's close near about 0.14% there. So there is no runaway that is happening. If at all, it will consolidate here and try to go up. Bank Nifty is the one which actually is up at 1.2%, encouraging, but still yet to really break out of even a 2-day high. And that is what we will look for going forward. Momentum trends uh, even but slightly towards the downside, 274 to 220. FII is continuing to sell 45 crores on 9th October sell. DI is bought 3,500 crores, so slightly tilted towards the sell side. HDFC Bank surprisingly, along with Kotak Bank, jumped today 1.9% and 4.1%. Mahindra also gained. Infosys, Titan, Trent, Adani Enterprise, Hindustan Levers, these were the stocks that were down today. In Nifty Next 50, more mixed bag. REC, Bajaj Holding, HAL, Motherson, BHEL, GAIL. So some public sector stocks have been coming up, and you had Torrent Pharma, Ambuja, Chola Finance, and Lodha giving up some ground. Sectoral trends, so you had private banks and Bank Nifty really leading the charts. Pharma actually getting crushed today, 2% down. IT also down, FMCG also down. So all the defensives are down, which gives some confidence that the market is likely to go up further. Private banks are have essentially come back to the election day high and taken support again and going up from there. So this is becoming a good base for most charts, as Kotak, RBL, HDFC, Axis, and IndusInd also going up. And in stock spotlight, you have Valor Estate, which really bounced today, which was earlier DB Reality. 192 rupees on that, up 10%. There is after the RBI speak of potential interest rate cuts by December, there is some kick up in real estate stocks. This stock has been rallying from 4 rupees to 200 rupees in the last 3-4 years and has been consolidating near the top right now. Will India's gamble in equity pay off? So this is what in money distribution infographic looks like, that half of India's money is invested in real estate, 51% is in property, 15% is in gold. So this is really encouraging that 15% of our household wealth is in gold. And gold, of course, as you know, have been giving 12% CAGR. So even if a person was not financially, so educated as a lot of modern day folks are, even if they are not aware of the products or financialization of products in the market, property and gold remains about 66% of the holding. Surprising, bank deposits are 13%, much higher than equity, almost more than two times at least. And the other surprise is that insurance funds are almost equal to equity. So insurance funds, which mostly are sold, or should I say missold, as insurance plus equity combined together, and those returns are never even close to what normal equity funds can deliver. So I would say 13.3 and 5.7. So this 19% buffer, this some of it can actually go towards equity more over a period of time. Pension funds and cash at 5 is fine. Equity investing by itself, this 5.8 figure has been on the rise. So last 4 years, there is a 300% increase in investor accounts, going from 4 crore demat accounts to 16 crore. You may say the active accounts may be less or so, but even if you assume 40-50%, 30% are active, even then the growth is quite phenomenal. 4x in 4 years. ET headline, investors are moving beyond property and gold. There's a growing cult on a regional basis. You can see that there is a 300% change over FY20 when it comes to North India, and even in East India you can see there is a 296% change. So there are pockets where there is significant amount of change. Even you can see Madhya Pradesh doing 389% change from the past. So it's quite remarkable in the last 5 years how where we've gone. Indian equities shining bright among emerging markets. Also, you can see emerging market flows of $86 billion in 21 months, of which uh, significant money is also coming towards India. Of course, FIIs have been on some selling spree in the last few months, but still the net flows are positive. Uh, the question, the big question that remains is that how many of these new investors are coming with a long-term mindset? Is this short-term hot money? I think 5 years is a reasonably long period of time that has happened now, where investors have witnessed some sort of 1.5 years of slowdown in the middle and some short spans of down moves, but they have not seen a long down move. That is the only thing that has been missing in the last 5 years. Uh, the money that has come in for quick money, quick bets in terms of gambling and speculation also is getting tested as more and more rules are getting formulated for making that life difficult. But equity, people are understanding with lower interest rates as the economy matures, interest rates are not going to rise. Interest rates may remain where they are or fall, and that, along with the taxation on the fixed incomes, is causing people to gradually shift into equity. If you have 100 rupees, take a risk of 10 at least. If you have 90 and 10, take a risk of 80-20, so on and so forth. So gradually move, and whether you may accept it or not, but a lot of influencers and YouTube and social media, this is reaching out to the bottom of the pyramid and causing inadvertently knowledge gain and exposure to maybe different products in the market. So while there is a lot of mis-selling and potential harm that is happening due to this, there is some good also that is happening. uh, and also you would assume that some long-term investors are also getting created as a mix of all this. So healthy mix between all asset classes, crucial for balanced outcomes. So we already have a very healthy real estate and gold allocation by most households. So if the equity can be made uh, more healthy, maybe from 5.8, we can go towards 10% over next half a decade, or even 1 decade. I think that will be a very good sort of balance that each asset class will have in the household savings. So what do you think about the rise of equity interest in India? What is your view? How the next 5-10 years will pan out? Do mention in the comment section. And once again, apologies for this early daily bite shoot, but I'll see you in the next one. Thanks. Bye.